Good morning, everybody. Thanks very much for joining us. The session today is designed to share insights, research, and really share discussions and communicate in terms of sectors. We held our first online briefing 2 weeks ago, which looked at the main research. We're now going to drill down a little bit more into the logistics sector. Great panel this morning. So we've got Robert Dobrzycki, who's Chief Executive Officer of Panattoni Europe. We have Marcus de Minckwitz, who's Director of Omnichannel Group at Savills. Stephan Riechers, who's Senior Investment Manager for Logistics at Union Investment Real Estate. Ingo, who's Managing Director for Gazeley North Europe. And also Kevin Mofid, who's Director for Research at Savills UK. Maybe let's start with you, Kevin. Just in terms of the recent research, maybe you could share some of the research with us and give us an update on some of the key research that you've been looking at Savills.
My role as Head of Industrial and Logistics Research for Savills covers the UK and Europe. The first part of this presentation will look at the UK, the second part, Europe, and that's when I'll bring in Marcus for some comment before we then go out to the rest of the panel. I've done this in two parts, really. The first part is some kind of is economic data and data on the retail market, because that's really important for the logistics sector. And then the second part relates to some property specifics, which will hopefully set the scene. So, perfect. Without further ado, I will crack on now. And also, I am prepared to share these slides as a PDF. So some of them are text heavy. Don't worry, you will get sent the slides as a PDF afterwards if you would like. So I won't spend too much time on this. Just this is a very quick economic overview. And again, I'm not going to go through this too much, but effectively you have two schools of thought in terms of the economics of everything that's going on. You have on the left-hand side, you have a very short, sharp downturn and a very quick, large upturn, a V-shaped economic cycle. On the right-hand side, you have a much more prolonged economic downturn. Now, when I first started presenting this slide, probably about 3 weeks ago, I think most people felt that they were on the left-hand side, short, sharp, quick, down and up. As time has progressed, I think people are much more now heading towards the right-hand side of the slide, and people are thinking, well, actually, this is going to have huge knock-on ramifications. We're not just going to pick up where we left off, and this is going to be something slightly more prolonged. And that's true as well, from the main economic forecasters. We buy data from Oxford Economics, amongst others. This was the Oxford Economics forecast on the 19th of March. A minus 1.4% downturn in GDP. I think we all realise now that is probably conservative. Indeed, Oxford Economics have revised their economic forecasts down much further, and for Q2 looking something like at least 20-25% fall in, this is UK GDP, but this is the same across the world. So just some interesting economic backdrop to everything that's going on. Now, I've been reading a lot in the press about online retail and how online retail is the savior for what's going on at the moment. Everyone's shifting to online. Isn't it great, etc., etc., etc. Now, I want to just dispel a myth very quickly. This is data from the UK, so I apologise that for those of you with the European focus, but I think it's important context for the economy with the highest amount of online retail anyway. And what this shows is actually, this is weekly sales data, online growth year on year. What it shows actually is that there were more weeks so far in 2020 where online sales were actually declining compared to rising. Now, in many respects, this doesn't surprise me because online retail is traditionally backloaded, November, December, Black Friday, Christmas. But we have seen a slight uptick in towards the end of March. but this is 0.6% growth. Now, the press would have you believe, the mainstream press would have you believe that, it's huge numbers. 0.6% growth is not massive. And what's it being driven by? Well, it's being driven by the food retailers. And this is, the sales growth for the food retailers in the UK. And you can see what's happening here. Huge surge in March. And rolling that forecast forward, look at this, in my opinion, is fairly sobering data. This looks at the total retail spend for non-food and food in the UK again. But look, April, 50% decline in non-food sales, 20% rise in food. Now, if you think about the UK logistics market, where over 2/3 of occupier take-up is related to the retail sector, I think this is fairly sobering material to look at for the next couple of months. So let's just look at some stats now, some property stats, and again, let's look at the UK because it's really interesting, in my opinion. The first quarter, Q1 of 2020, was actually the third best quarter of take-up in the UK we've ever recorded. Absolutely fantastic. Puts us on a very good foundation for the rest of the year. Knowing what we know about Q2, there's about 8 million square feet under offer at the moment that we expect to complete in Q2. Having gone through those lists of deals, these are strategic requirements, long-term requirements, not going to be affected by what's going on. So actually, we could be in a very bizarre situation that at the halfway point of 2020, occupier demand for warehouse space could be significantly ahead of where we were in 2019. And that doesn't even include any of the short-term requirements that have come forward from retailers, and unfortunately some rather more morbid requirements from people like the National Health Service and also the Ministry of Defence, who want to take warehouse space for reasons related to the virus. So it could, at the half year, it could be very, very interesting in terms of take-up. I think take-up is going to be a lagging indicator, however, and it's going to be Q4, really, that we see any trends in terms of where demand is heading as a result of the virus. And I'd be interested to discuss that as part of the panel moving forward. I want to just talk very quickly about supply as well, because this is really important. I want to really talk about this point about vacancy rates. We have a vacancy rate of 6.8% in the UK. Rents have never increased when vacancy has been above 12%. It would take 40 million square feet of new supply to come to the market to get us to a vacancy rate of 12%. And that is our tipping point for rental growth. So I think it's really important to make that point, that the supply dynamics, because of prudent speculative development, the supply dynamics are still very favourable for landlords and developers in the UK. And actually, and as this slide demonstrates, we're seeing speculative development in some cases stop. And speculative development, if that stops, then actually grade A supply is going to decrease as well by the end of the year. So if grade A supply decreases in many of our markets, there is a strong argument to say that even with occupier demand lower than it has been, you will still see rental growth in those markets. So, they're the occupational dynamics. One data set I just want to draw your attention to is this, which is requirements. Again, what you can see here is, yes, the requirements for warehouse space from operators are falling slightly. That's the red line. But the average is still higher than what it was in mid-February and mid-January. So all things being equal, I think we're in a very good place. One more slide to just talk about. I've got about a minute and a half left before we head on to some questions. is what will the future look like? And this is, this is just a collection of headlines, really. And I think what's really important here is the collective schools of thought that actually supply chains are now too lean, and people are going to start thinking about nearshoring manufacturing. You saw the president of France just yesterday saying supply chains need to become more French, and you had the finance minister from Germany saying the same thing. So, if we're going to see much more nearshoring and manufacturing in our own nations, what does that mean for our world? What does that mean for our sector? And then just the top right, is Southern Europe finally embracing e-commerce? Well, I mean, this would be fantastic, because as this slide shows, we noticed it was when online retail got to 10.7% in the UK. That's when the demand for warehouse space started to increase dramatically. And if you look now, there's a whole host of countries around that 10.7%. But if you look, there's also a whole host of countries that are hovering around 5, 6, 7%. And will this crisis change this chart dramatically? When we put this chart up in say 18 months, will we have seen the 5-year forecast realized in 18 months? And if that's the case, then actually we can see a need for an additional 15 million square meters of industrial space across Europe, just from the demands of online retailers. So at this point, I'm going to just bring Marcus in to talk about some sensitivity analysis.
Yeah, so just on the slide before, that was what we were saying before the COVID crisis. So if we just looked at forecast online growth in the share of online sales, and then just your standard growth rates of the consumer markets. And if you move on the slide, Kev, to the next one, I think we were just saying that, online penetration was predicted to grow at an average 8.5% per annum, and retail sales were forecast to increase by 2.5% per annum. And I think that, as Kev says, a lot of the press and a lot of the commentary in the last couple of weeks has got excited by the growth in that online sales rate. And I think we can all see that there's going to be a huge bounce when we look at these figures. And we can all probably judge by ourselves and our own shopping habits whether or not we're going to go fully back to the shops and revert back to our previous way of living and way of spending, or, as I believe, there will be a bounce in that 8.5% over the next couple of years. The issue, though, sorry, Kev, just going back to the slide before, the issue, though, is that, it misses a big point, which is the consumer spending markets. And I think it's going to end up as a bigger slice of a smaller cake. We've run some sensitivities. So, just looking at the bottom table, we were broadly saying 15, 16 million square meters of demand over the next 4 years from the rise in online spending. And that's our base case. If you assume that the share of online doesn't change at all, but we see 5% drop in consumer spending over the next 5 years, that could almost half. And that's kind of the sobering thought behind this. Now, if that rebounds quickly, like a lot of the economists think that it will, and we see a boom in online spending growth, then you can see how it's going to quickly rise quite significantly. But it's that play that we've got to be careful of as we kind of make judgments over the short term, at least, going forward about this boom on online spending, because of total spending being completely cut back. And then, Kev, if you just go through, and that just shows it in a different way. I mean, again, in Europe, we were seeing take-up kind of reaching record levels, and, we're expecting that to continue. Again, I think it's similar theme to the UK. Kev, carry on through. And this was then playing back to Kevin's earlier point. So a lot of the work we've been doing in the last 12, 18 months was helping with investors understand what the rental growth picture is going to look like across Europe over the next 5 years. And the record low vacancy rates, given experience we'd seen in other more mature markets, pointed to really significant rental growth. And that kind of was what was the foundation of the record yield compression we'd seen over the last couple of years. Obviously, for the short term, that's all being thrown in the air, not least just because of a sense of affordability and corporate decisions. But when we play that through to the next slide, This is just a reminder of, how small rent is in the supply chain equation. And I think that one thing coronavirus has done is kind of highlight the importance of an efficient supply chain. And what we've been saying for a long time is where real estate massively benefits other contributing factors such as labor, such as transportation, other things that will probably come onto this call, what rent they're paying actually becomes a little bit more irrelevant, and they're willing to pay a more significant premium to be in those right locations, in those right buildings. And I think that actually from the coronavirus point of view, it will just highlight, as I say, those are the determining factors, because they'll have seen now what happens when they're stretched, what happens when the huge globalized supply chain stops working. And they'll be thinking more importantly in the future about how they would survive a similar crisis and how they can carry on over the next 5-10 years.
Thanks, Marcus. And now, Richard, over to you.
Great. Thanks very much, Kevin, and Marcus, for that. Lots to pick up. Let's just briefly go through the panelists that we've got today. So maybe if we just take a minute each just to introduce ourselves. I forgot to do that at the beginning, so I'll do it now. So for those who don't know me, my name's Richard Betts. I'm the publisher at Real Asset Media, and we run around 60 events a year, publish Real Asset Media, and also a daily news service which is called the Real Asset Day. These sessions have been specially created really to be able to, I guess, connect and share in a difficult time, challenging time for the world, not just the industry. And I'm really pleased, actually, that that in terms of the event that we've got today, there are 27 countries represented here, including Japan, Singapore, Hong Kong, India, the US. So delighted to be able to reach out not just to our traditional audience in Europe, but also via these online events to a wider audience outside of that. So. Great, thanks to everybody for joining from there. Maybe let's just start with you, Robert. Just give us a quick minute on yourself and Panattoni and where you are in this space.
Sure. So my name is Dobrzycki. I'm CEO of Panattoni Europe. Panattoni is a US and pan-European logistic industrial development company. So we are in Europe since 2005, and we operate in almost all main markets in Europe. And we are our core business is obviously logistic industrial, and we are a development company.
Great, thank you, Marcus.
Yeah, so I'm a director at Savills in our European investment team, and principal focus is logistics, but I spent 10 years working in our UK business covering retail. So I come from that background, and at Savills we've been trying to look at logistics through a retail lens, if you like. We called it the Omnichannel Retail Group for a name, but say the principal focus is European logistics investment.
Great, thanks very much. Ingo.
Yes, my pleasure, Richard, and I'm absolutely with you. Your events are absolutely great, and Expo and Transport Logistics is always worthwhile to attend this. Just a short summary, who is GLP? GLP is a leading investment manager specializing in logistic and related technology investments. We have over 86 billion of assets under management in real estate and private equity, and 60 million of square meters. We are active in 4 continents. We have 2,000 properties and covering 630 logistic parks, and have an existing land bank of 15 million square meters. I'm responsible for Gazeley North Europe, and I'm with Gazeley since 2007. That's me, yes.
Great, thanks very much, Ingo. And Stephan?
Hi, I'm Stephan Riechers. I work for Union Investment since 2006. Union Investment has approximately 45 billion euros assets under management spread over different asset classes. The logistics share is approximately 2 billion euros worth, and we doubled our logistics share last year. and we will try to double it the next 3 years again, hopefully.
Great, thanks very much, Stephan. And I appreciate the video link didn't work, so thank you for persevering via the phone link. That's great. And last, Kevin, just give us a kind of brief update on yourself.
Yeah, head of logistics research for Savills. I've been on the research side for 12, 13 years now, something like that. And you know, as I think I've said before at your events, you know, when I first started my career, nobody wanted to talk to me, and now I get invited to all sorts of things talking about, you know, warehousing because of the structural changes that have gone on during my career.
And thanks very much to you also, Kevin, for joining, because I know that you've got very young twins. So if at any point Kevin has to rush off, then that's what it is. Good. Let's dive down a little bit into some of the topics. And I'm just going to try and just launch a quick poll here, just to pick up on the discussion that we were having there, in terms of online retail, just to see, as a result of COVID-19 and the current health crisis, are you likely to spend more online than in the past? It's an interesting one. I won't tell you my view until we conclude that, but let's just pick up on that a little bit. Stephan, in terms of your view, I guess, how do you see the impact of the current health crisis on the logistics sector? Do you see it as being more resilient potentially than other sectors?
I think so. In comparison to our hotel and our retail assets, until now, our tenants spend all the rent for April in the next quarter, and it seems so that in logistics it's a little bit more resilient, but we will have the full picture, I think, in the next month. From the point of now, I think it's too early to have the full picture.
Okay, good. And just picking up on that, Marcus, in terms of the retail, we're getting some interesting polling in, and it looks at the moment as though kind of 60% of people feel that they will spend more online than in the past. Just in terms of the impact of that, how will that compare? Because, for example, we've also got in the retail sector, we've got a lot of bad news in terms of retailers potentially going to the wall, and therefore that may also impact on supply in another way in terms of the logistics side. I suppose, how do you see those two sides of the coin?
Yeah, and this is where, you know, we just have to take that sense check and realise that the logistics space isn't immune to wider issues, and ultimately casualties in the retail sector will bring back secondary space to the logistics market. And when you're looking at rental growth, which, as I said earlier, is quite an important factor for investors looking at this sector, you've got to carefully monitor those supply and demand dynamics. And you bring in another side to the equation, as Kevin said, which is a reduction in the amount of speculative new space coming through. So that's a big driver, then reducing supply. And we do know that increased online spend directly translates into increased amount of warehouse space. And then when you build in also increasing capacity within the supply chain, then that increases supply. So I think the supply and demand dynamic story is actually, over medium to long term, probably set to improve. But it's just the amount of secondary space that comes through that could start playing with those dynamics in the short term, which we're saying people have got to be really careful of as they're making their decisions to where and how to invest.
Maybe, Marcus, I can add something to your topics, to your thesis. I think the virus or the corona issue now brings some facts back to developers, investors like us. We need to look at real estate essentials, fundamentals. If the warehouse is okay, if the spec is okay, if the design is okay, if the destination is okay, even if we have some issues with tenants, I think a reletting scenario is quite easily to describe. It brings it really back. Is the location okay? Is that real estate piece okay? And then I think even bigger boxes we can bring to online retailers or somebody else very easily. That should be as well a business case.
Okay, good. And Robert, maybe just picking up with you. I mean, obviously, logistics, very established as an asset class in terms of institutional investors, and essentially, it's been flavour of the month for a number of years. How do you see that continuing in terms of institutional investors? In a way, do you see this as becoming more attractive in terms of capital flows? What's your sense of that, Robert?
Yeah, I mean, currently, obviously, there is quite a big uncertainty right now on the market, but this is pretty obvious that we are during the lockdown and the situation is quite nervous. But our view and our feel is, when we discuss with our investors, is that obviously, and this is also what we see demand-wise, that this asset class feels one of the most resilient asset classes right now in the market in terms of investments. And we feel that after the dust settles, there will be quite substantial redirection of capital towards our asset class. And the same view we hear and we share with the banks that are financing the real estate that we build. So feels like this is, I mean, the coronavirus situation is accelerating the well-known trend moving to online retail from traditional retail, and this is now clearly visible. And investors, but also clients, are, in our view, are now having a kind of a real view that probably were a bit underinvested in the asset class and in the e-commerce channels. So this crisis showed that probably that was the best investment, and that's going to be a best investment going forward. So it's like visible today that people should start reallocating resources, and that's the feeling we have. And in our review, obviously, it's hard to judge what will happen this year in terms of kind of a short-term view. But next year or in 2 years' time, we will see a huge redirection. So I think it's kind of a very positive for the sector. Obviously, with issues on the way and uncertainty on the way right now, but still we should be in best shape from all the asset classes, commercial asset classes, which are not on the market right now.
Good. Thanks for that, Robert. And I forgot to mention at the beginning, but fortunately, others have noted that you can ask questions, and we'll also pick those up. So at the bottom of your screen, there should be a Q&A one there, and so please do ask questions, and I'll make sure that we also address those to the speakers. It's designed to be interactive so that we also answer your questions. One question that's come in, and this is for anybody really, it'd be interesting to get particularly the views, I think, of the investors on this. Do you already see tenants asking for rent reductions in heavily affected sectors like automotive? Interesting just to get a sense from you guys about whether or not you're beginning to be asked about rent reductions, those kinds of things, because obviously that's been a big concern in areas like retail and office and those kinds of sectors. So I don't know, Stephan or Ingo, have you got any kind of view on that? What are you seeing at the moment?
Stephan, would you like to answer this question?
Yeah, for sure. As I mentioned before, until now, we have no rent reductions for logistics and industrial, but some tenants announced that they need to speak about this in the next month. But from the point of now, we haven't seen any rent reductions, fortunately.
And Ingo, what about you?
I think it's the same what introduced by Stephan. We do not have rent reduction at all. We have some automotive supply who are asking us that we help them for 1 or 2 months. But being an asset manager and a good agent for our investors, we always discussing what is the situation, how can we help, or we can help with the government, for example. And we may, and always that is very interesting to see, if we can help, the tenants are helping us as well. They are prolonging the lease. I have one case where the remaining lease contract was 6 years. We have a little bit of rent-free now, and now we have a 10 years lease agreement with them. So absolutely good. That is absolutely what we see through our portfolio. That's a belief in the destination. That's a belief in their warehouse operation. That's if we are able to help them short term, we can prolong leases and maybe a better headline rent or something like that. No? It's always a deal behind it, and I think that is a good signal for our investors. I think what we need to look at is as well how are the different economies and how is the GDP in countries for example like Germany. We see coming back to your question Richard, in respect of car manufacturing, for example, what we see at the moment is that big car manufacturing companies have to shut down their manufacturing plants because there is no parts that they need for producing their cars, and that will have an impact on rising inventory levels, because they cannot afford to wait on parts so that they cannot produce. So again, there will be a lot of demand for warehouses because they need that inventory to produce their goods. So again, a good signal for our asset class.
Okay, good. Interesting question coming in from Svavir. Thanks for joining us, Svavir, which is around spending. Spending, of course, is a key factor in all projections made. Do you think that the virus situation leads to delayed spending, or will it result in cancelled spending? And in terms of that, will we look at a steep rise in spending once society returns back to normal? Maybe that's a question for you, Marcus, or Kevin. I mean, interestingly, I know that from the macro session that we did, that there was a bump in terms of China, as soon as lockdown was ending, that suddenly everybody went back to the stores and there was a lot of focus on retail and food and beverage and leisure. What's your sense of that? Maybe start with you, Marcus.
Yeah, I mean, interestingly, actually, our retail team in China came back with some stats last week to say that since the shopping centres had reopened, and the weekday, they were at about 50% of the numbers and footfall that were there, for the same week last year. And at the weekend at about 80%, which personally I felt was quite high, given that they're probably only 2-3 weeks post-lockdown to have that confidence to go back to the shops. I think that, we're all expecting probably to rebound quite quickly from this. But like everyone, we're probably also just keeping one eye on personal finances and thinking, how loose can we be with our cash? And I think that for certain goods categories, and this is where, again, you've got to split it down into that kind of level, there are going to be areas of the sector that are going to take longer to recover as people put off kind of that discretionary spending element of their lives until we've just got more confidence that, we're going to be through this and the economic recovery is going to be, quicker and perhaps softer than perhaps some of the commentators are saying.
Robert, maybe for you, do you see supply chains are going to change? Are there going to be lasting changes from this crisis with, I suppose, different sizes of distribution centres, smaller stores, also delivery options that are already proposed by Bolt and those kinds of things, but also particularly, will global supply chains change? Will there be a reduction in manufacturing in China, more diversification, more local production? What's your sense of that, and what does that mean, I suppose, for the types of real estate that the logistics sector will be looking for going forward?
Obviously, it's hard to judge what will stay in the long run. In the short run, obviously, everybody's emotional and is adjusting quite quickly to the situation in terms of supply chain. So we see that people are talking that, as discussed before, that supply chains are a bit too tight, were a bit too tight, too efficient in terms of cost, and they were not resilient enough. So obviously that's immediate kind of a feel. But as we all know, in 2-3 years, for a time, it might come back, and people would be still efficient, trying to be efficient again, and will forget about risk and resilience. But feels like that's what will happen. Also, diversification of supply chain. I mean, and production probably coming closer to the customer, probably coming closer to end user from Asia, and diversifying sources of production is going to be also another emotional effect of today, and that should be obviously positive for European logistic production scene. So yes, clearly that there will be some adjustments. Question if there will be short term, medium term, or long term. Probably some of them will stay long term, and this resilience and diversification probably will stay long term. And on top of it, obviously, as discussed before, this shift to online is accelerating in a I think overnight in a huge way, and that's going to stay. And this is the main theme, continues to be the main theme, accelerated by the coronavirus situation.
Okay, good. Lots of questions coming in, which is great. And you can also help me, I forgot to mention, you can like a question, which means that then it goes to the top of the list, and that makes sure that I definitely will ask that one. Good. I just wanted to just pick up a little bit. Ingo, from your point, obviously you're looking after Northern Europe. Are you seeing, just picking up on that last point from Robert, do you think you'll see more nearshoring, more, I suppose, in terms of the industrial side of it and the production side of it, more of the production being done closer to home, whether that's, let's say, Poland or Czech Republic or areas like that, or even in Germany itself, rather than across in Asia? What's your sense of that?
Yes, absolutely, Richard. This is absolutely a very important question. I think being responsible for the Northern European operation of GLP and the GDP is here in Germany 25% related to manufacturing. And we will see absolutely that diversifying the manufacturing location. That means that companies who are acting global-wise, bringing now back their manufacturing plants to Germany or to the Benelux. And is because they would like to be at the consumer's end. And one trend which we need to pay attention to is, for example, Industry 4.0. That is, again, a trend that manufacturing plus consumer end is very nearby. For us, it's a very important question, how is the reaction of the government on that? So that they see that we need to bring something home, like Macron has already said as the president of France. Do we have the sites and the possibility to do so? Because we have one trend, everything is going very green, nobody likes logistics, but I think in these days, everybody has seen the importance as one of essential, having a great infrastructure and logistic, and that needs to be adopted by the government. That we have more opportunity to develop warehouses, last mile logistic warehouses, sorter center, and e-fulfillment centers.
Okay, good. There's a very popular question for you, Stephan, so I'll address it now, but it's also a general one, I think, for others, which is about valuation, pricing, yields. But this was particularly addressed to you, Stephan, so I'll ask you first, and then we can address it around the team. So does Union Investment still pay market purchase prices like before the virus, or have yields been adjusted downwards? So I suppose let's broaden that a little bit, Stephan, and just talk about valuations more generally, how do you see that? How do you see it influencing that? And also, I suppose, what's happening in terms of deals? Are you still moving through with deals in general in the market? Has there been a pause? What's the general situation, Stephan?
I've had a lot of talks about this theme the last weeks, and there is no clear view on this. For the running deals we are in, we are a reliable investor, and we stick to this, what we said before the crisis. So we move forward. For new investments, we are very picky on the covenants, especially on the creditworthiness of the tenants. That's a main issue. And for the future, I think because of the growing demand and the limited opportunities, and the yield can drop further. But please don't ask me where the bottom will be. I think there are a lot of investors outside who will shift from retail and hospitality to logistics, and I think there will be a lot of demand coming to logistics and industrial.
Interesting. So you think that in terms of investment commitments, I suppose, from institutional investors, that they'll actually be reallocating, recycling some of that capital away from other sectors and into logistics.
Yeah.
Okay, interesting. Another question that was one I wanted to address, and it's come up. Does anybody else want to pick that up? By the way, just I don't know whether there's any other views on that before I move on to the next question.
Yeah, absolutely. I think we have strong beliefs in our asset class, and it's not only us who is raising a lot of capital. If you see the daily press, global-wise, and I'm very happy, Richard, that you have invited Asian investors around the globe, and US Americans are very strong. Blackstone has raised now, I think, $1 billion logistic fund again to invest in Europe in logistics. I think the guys from Mapletree are doing the same, coming to Europe for investing heavily in logistics. I think Savills investors and sort of press release in that respect as well. I think in these days, I think the fundraiser in logistics are doing a great job. Have the mega trends in their view that logistics is really the asset class to be invested in.
Yeah, I think, Richard, the one point to note though is, cost of debt. That's the big underlying factor here in terms of pricing. And had this happened 12, 18 months ago, where particularly Korean investors were paying record pricing across the piece, really, particularly for prime assets such as Amazon's, they were marked way ahead of European investors who are the traditional, more equity-backed players. So then the Europeans caught up, but the Koreans haven't, softened their return hurdles or lowered them to be able to pay the same prices, and debt has increased, and that's got to have an impact on bottom line pricing from those pools of investors. And then if you're talking to anyone who's a full equity buyer at the moment, they're being pickier, as Stephan has said, but also you're in a reduced buyer pool and you probably want to see something for your money right now. So I think today the buyer pool is reduced and debt has got more expensive. But what we are believing is that once we're through this and returning to any form of normality, the amount of money chasing the sector means that the rebound will be quick and perhaps even take us beyond pre-COVID pricing.
Okay, interesting. Robert, pick up on that, if you will, in terms of valuations and pricing. But also, I wanted to just pick up on some of the things that that were mentioned in the research at the beginning, which was about speculative development. Obviously, that was back last year, but also just the availability of space and what happens. Is speculative development still going ahead? How do you see that?
Yeah, so maybe picking up on the valuations. I mean, I think for a while, obviously, as mentioned before, there is a bit of uncertainty right now. So fundamental strength of the asset class might be not recognized fully in the short run. So it's going to be very hard to value the asset for the next month, 2 or 3. So that's going to be pretty clear. But we believe that probably pricing of the assets, industrial assets, would probably next year will come back to the before coronavirus levels, and probably as mentioned, probably is going to be lower than that. So in the short run, the liquidity and the uncertainty would be playing quite a role in valuations. So if you don't have to sell, probably you shouldn't be selling in my view. And you should be pushing everything to the next year, where the capital should be coming back in a huge wave, and obviously there would be a reallocation between asset classes after the dust settles. So that's clearly the investment field. On the speculative construction, obviously the same. I mean, it's a bit of uncertain time right now. So if you can, obviously you need to be very selective, and if you can and wait and see a bit, see how the coronavirus situation would affect the tenants, how many units will come back to the market, what exactly is going on in terms of construction pricing, which we feel probably for a month, 2 or 3 or 4 or 5 will go down a bit. Then you kind of judge what to do. We are probably not pushing so much spec, but selectively we would. And selectively would be watching pricing and demand, supply fundamentals, and we'll continue to push in some markets speculative construction. Because if you think, I mean, your construction cost is going down for a while, will be going down for a while. If you believe that your asset class is the right asset class and your building is the right building, which you're building in a low cost environment, knowing that this space would be let because it's in a great location and e-commerce, and the situation would come back and is coming back, and then you build into the market, which gonna be next year market in terms of investment and yield situation, then probably that's not a bad investment decision, and that's not a bad bet. And that's also how we are looking at speculative developments these days. Selectively, that might be, if we start a good deal, it might be a best deal we've done over the last several years. So this is the view we are taking.
Okay, good. And is that position the same for Gazeley, Ingo? What's your sense of that?
Absolutely. I think not only speculative development, we are having a development pipeline of BTS deals with great online retailers who everybody knows, for example. And we are doing speculative development as well. And I can really announce that any speculative development, which is completed maybe in September or the fourth quarter of 2020, is already leased. And the lease duration were during the crisis now. And starting now speculative means if you do some soil improvement and the boxes are coming to town in the second quarter of 2020 or the first quarter of 2021, I think that's a great time to get it leased again, because I think the mega trend is absolutely there. Everybody would like to do online. Even elder people are doing online. During our session, for example, I had 3 rings at my door because my Labrador was barking. Somebody from DHL and from Amazon was standing in front of the door. And if you're looking across the street, a lot of packages of Amazon, of online retailers, everybody is ordering now online. And I think it's a great time. And we should have strong beliefs, even for speculative developments, that they will be leased up as agreed in our underwriting even faster. That is my point of view.
And it's interesting. I mean, one thing I wanted to pick up on also was one of the issues in sessions that we were having, particularly last year on logistics, which obviously had a very different series of discussion points. But one of those was the lack of workers, and also construction costs going up. So you'd got increased pricing feeding in there.
Can I come in on this point, Richard? I think it's really interesting. What this crisis will do, I think, is in many respects amplify the issues that were already at play. So we were talking about labour, and we were talking about automation, and we were talking about energy, before the crisis. And I read an interesting article yesterday, I think in The Economist, and it was saying that Western companies will bring back to their shores processes that they can automate. Well, processes that they can automate means robotics and advanced fit out of your warehousing. Well, if that's the case, then that's amplifying what was happening before the crisis, and we're still left with that point about energy, which is the arguably the new battleground for where people will choose to locate and develop their warehousing. And also, just whilst I've got the camera, because I do have to leave at past, because as Richard said, I need to help out with two very hungry 9-week-old twins. But about consumption, consumer demand, and I think it's worth making the point here. It's kind of crystal ball gazing in some respects, but and Marcus has already alluded to this, is okay, yes, are we going to have a bigger slice of a smaller pie? The question is, how will consumer behavior fundamentally change? And I can only talk from personal anecdotes at the moment, because that's kind of all we have until some data comes through later in the year. But we have subscribed to our local milkman. Now that's a very British type of thing to do. You get somebody delivering your milk and bread. Before the crisis, we didn't do that. Will we continue to do that once the crisis is over? Well, we might do, because we're supporting a local business, and that feels like a nice thing to do. Again, I can only speak on behalf of my parents and my wife's parents. They have now both done online shopping, and they've used HelloFresh, delivery boxes. They never did that before. Will that continue in a year's time? Or will the Amazonification of retail just continue unabated, and in 18 months time will the defining factor be, actually, I want my iPhone delivered tomorrow, where I want it, and so on. So has consumer spending fundamentally changed, and all of these nice things that are going on, will they continue? Or are people's memories short, and we'll just revert back to what it was like? Either way, I think the logistics sector benefits in some way. It's just the margin of benefit varies.
Okay, good. Because we've got a limited time left, I'm just going to run through some of the questions which broadly fit into some different categories here. Some are around, is actually a major risk more likely to be the fact that you've got potential issues in terms of a global recession? How much does that play against the amount of economic stimulus that has gone in? So how do we expect to see those play out? Is that a risk or potentially a benefit or to the logistics sector? Also on because we've got borders closing, is that likely to have a longer term impact, or is that likely to be a short term impact? And just an interesting one that I wanted to pick up in terms of some of the other sides. Will retail convert into logistics? So traditional shopping centres may change. There's a lot of discussion around that, and also if we expect there to be a significant recession, isn't that likely to have an impact on the headline rents? So I don't know who wants to pick up any of those topics. Stephan, is there anything you want to pick up in terms of those?
No, not really, because I read so many different forecasts the last days, and unfortunately, there was no real common sense. And so I try to avoid make further outlooks around rents and demand and so on. I think, as Robert mentioned before, from the point of now, there's so much uncertainty in the market, and it's very hard to predict seriously what will happen in the near future, to be honestly. But I think what will stay is it's a war for land. You've seen that in all of the countries of Western Europe, and I think and that will stay even after the Corona crisis, and I don't think that the rents will slow down.
And that's an interesting point, because I guess in terms of thinking about nearshoring, if you were to try to move some of those back, let's say, for example, some car production elements back towards Germany, I guess that may create a space in terms of zoning, particularly in somewhere like Germany, where that's all very tight.
Yeah, definitely, but you have this in France and in the Dutch market as well. And I think it's not so easy to receive the right permissions in Poland as well. Robert, you're the better expert than me, but I think that this trend will stay.
Robert, just picking up, I saw that the Amazon were expecting to, or were seeking at least an additional 75,000 workers. Do you see that as a sign of further online expansion in general? Also picking up the point there from Kevin, do you see that that there just is going to be this whether you call it Amazonification, but do you see that as a really lasting trend?
No, absolutely, and obviously the recent news about Amazon is probably linked with a direct need of today, but it is clearly a trend, and it feels like probably companies like Amazon, they had never better time in terms of volumes than they have right now. So feels like this is a trend which gonna continue, and clearly e-commerce is a kind of a winner of the situation. If there is a winner, you can't be a winner of coronavirus situation, but you clearly see the trend. And even if somebody was saying, well, yeah, it will take a bit until the whole thing would go to online. It's clear right now it's going faster than everybody thought, and clearly Amazon is a company that you watch and you see the trend. So it's pretty obvious. There is nothing new here, and but it's even more obvious right now.
Okay, good. I want to finish on time, or at least approximately on time. So maybe just one final question for everybody, which is, I suppose, I guess, when is your best guess about when it will begin to move through this crisis across Europe? Are we looking at September? Are we looking at June? Are we looking at? When do you feel we'll be back to some form of new normal? I guess, and also, if there is something positive that can come out of this, and I'm not thinking necessarily just specifically of the logistics investment side, but in terms of trends, is there anything that you've seen that you feel could be positive that's come out of this crisis? Where should we start? Let's start with you, Kevin, because you've got to rush off.
I think we're going to have to take. For me, I'm following what happens in America, because there is a lot of chat in America that the cure, as in the lockdown, is not potentially worth the economic fallout. And so it'll be really interesting to see what America does. Now, personally, I think we're talking about the preservation of life, which is paramount. But if America moves, then the pressure for Europe to follow will be immense. And so if we are getting back to some level of economic normality around June time, then that would suggest to me that we're having kind of one quarter of chaos. In terms of a positive, there are very few at the moment, and the idea of nearshoring has always been talked about. And the idea of nearshoring has always been talked about, and fundamentally it comes down to whether the consumer is prepared to pay for it. So is the positive that the consumer will change for potentially be a more socially aware consumer as a result of this.
Great. Okay. Thanks very much. Stephan, any sort of final thoughts for you on when we might be through this for a new normal?
Yeah, as I mentioned before, that I've read so much articles about this and from so many experts, and nobody knows it. But I think it has to end the lockdown. I think at last at June. Otherwise, we can shut the whole economy down, and that this will have a lot of impact of the whole life. And the positive outcome for me is that home office works. So I was very critical before, but I've seen if you arrange with this in a proper way, it works, and you can communicate nearly as in the office.
Great, thank you. Marcus?
Yeah, I mean, gosh, I haven't got a crystal ball here, but I think it's going to take a few months for things to settle down. We haven't touched on the massive fiscal stimulus packages that have been pumped into the economies. Hopefully they will alleviate some of the short-term pain, but it will take time for that to flow through, particularly to consumers' pockets. And like everyone, let's be optimistic and hope we can be back to work in June, and then by the end of the year, we'll have recovered and socially recovered economically and be on a more normal footing. And then the positive is that all of this, I think we universally agree, is going to generate more demand for logistics. We were already on an amazing growth story, and it doesn't feel that anyone thinks that that's going to stop in any way. The short-term pain is going to be felt through wider economics rather than necessarily anything to do with the sector itself. And finally, I think it'll be interesting just to see when we do get back to work and people start looking at what's happened with the environment, how the green agenda comes to the fore over the next 6 to 12 months. And we realise just perhaps some of the positive impacts that came from everyone stopping travelling and deglobalisation. Because I think that could have a really, really big impact, over the next few years.
Great, thank you. Ingo?
Yes, Rich, I'm very optimistic about that we are coming back to business very soon. Today, the government of Germany will have a session about what are the next steps to get back the economy where it has been before in the quarter 2019. For me, I think, as mentioned all before, we have three fundamental trends for being very optimistic for logistics. That is the rising inventory levels, it's the continued e-commerce adoption, and the diversifying manufacturing location. So all good from our point of view, being an investor and developer in terms of logistics real estate.
Great, thank you. And last, Robert?
Yeah, I do agree. I mean, you can't have lockdown forever. It has to come back to normal. Obviously, and in order to kind of continue and not to damage the economy, obviously. So I think June, we should start seeing coming back to normal. It's not going to be normal for a while. fully normal. So I think 2020 would be a year of kind of coming back to normal. But it's clear it's a kind of a logic that it has to come back. So, and then obviously next year we'll see what's the real effect, what's the real damage, because now we just kind of, it's hard to say. It's reaction, it's, you count losses, you see what's going on, there's uncertainty, so it's very hard to judge. We need to watch it closely. I mean, there are definitely positive trends in logistics. Might be negative that we'll be going into kind of a bit of a slowdown recession right now, which on one hand is bad. On the other hand, maybe it's kind of refreshing in terms of construction costs, in terms of labor. I mean, it's like a bit of reset that maybe the sector needed to kind of consolidate and then really start thinking of what we are doing, because so far we were just rushing forward and trying to catch whatever was in front of us. So I think that's negative, positive, but next year I think overall it's going to be very interesting. And this year it's going to be probably a bit bumpy, but we'll go through it.
Great, thanks very much. Thank you also to everyone for joining us today. Kevin, I remember having one baby being quite a logistical challenge. So 2 twins at 9 weeks, I think that's quite a significant logistical challenge.
I'm on first name terms with our Amazon driver.
Thanks very much for joining us, and look forward to the next session that we have on logistics. We'll be doing one of these events approximately every week, so please do sign up for other events on the website. And thanks once again for joining us. Thank you, everyone.
Thank you, Richard.
Thank you very much.